Today I'm going to talk to you about macroeconomic policy. Before I start talking about macroeconomic policy, let me put it into perspective for you. Okay, the study of economics has two main branches. If we look at the whole side of the whole economy, talk about national spending, production, employment, inflation, which we'll be talking a lot about, we're talking about a macro, a whole economy perspective. Alternatively, if we talk about micro, meaning small, we're looking at a particular firm, an industry, or an individual market. Okay, so if we talk about micro economic policy, we're talking about the competition policy and trade policy between the industries or the firms within that particular industry sector. If we start talking about macro side of things, we're talking about fiscal policy, monetary policy, and that's really the crux of what we're going to be focusing on today, talking about how governments can manage our economy using fiscal and in monetary policy. First of all, I must talk to you about the economic cycle, because everything pinches about the economic cycle. In order for the governments to manage the economy, they must have a knowledge of whether the economy is currently going in upturn, whether it's in a boom, downturn, or indeed we're in a recession or, in extreme case, a depression. In an upswing or boom, we have the following things happening. We've got lots of spending, high levels of investment, high levels of inflation, and low levels of unemployment. The two big focuses of an upturn is the high levels of inflation and low level of unemployment. Now let's look at the other side, when the economic cycle's in a downswing or recession. What we see there is low levels of spending, low levels of investment, high unemployment, which is the big problem, and fortunately lower inflation. Just out of interest, what's a double dip recession? Okay, have a look at this YouTube clip, and it really explains well what a double dip recession is in context of a business cycle and so forth. I'm going to ask you to watch that.
Double dip recession. I remember as a kid first hearing this term, and I thought it was yet another treat at Dairy Queen. To me, it sounded like a good idea, double dip. But actually what it is this phenomena that happens in business cycles. As the economy is coming out of a recession, it just sort of loses its emphasis and everything slides right back in. What happens is the economy starting to pick up, but then people become weary. They're not sure, is this for real? They won't spend. As they don't spend, businesses are not going to hire people to increase output if they're not sure that they're going to spend it. So what happens is those animal spirits that John Maynard Keynes referred to all of a sudden start to turn negative, and instead of climbing out of the recession, the economy slides right back into another one. That's what a double dip recession means.
Now the reason why we're doing all this, looking at business cycles, is to see how we can predict economic growth, and then based on that, how well the economy can be managed by our governments. Here's a little short cartoon. It is very difficult, as you can appreciate, to predict the economy. It's a bit like predicting the weather in Melbourne or indeed Launceston. Okay, what we've got to do when we start looking at the economic cycle and the business cycle and economic activity, we've actually got to look at what the actual graph tells us. This is the latest set of GDP figures from about 1990 to about, well, its most current one as of March 2013. You can see here we've had a number of peaks and troughs, and currently, and this is the important bit, the GDP per quarter is trending down. The trends over time have been that we've had peaks, as you can see here, in 95, 98, 2003, 2007, and there's another one, 2011, which is coming down from. And correspondingly, we've had some troughs in 98, 2001, and the big one in 2009. When we look at trying to predict the level of economic activity, we look at various economic indicators. There's three types: leading, coincidental, and lagging. The leading indicators indicate a change before changes in real GDP, and that's the map that we saw before, the graph that we saw before relating to mapping GDP. So there's lots of things that indicate ahead of time what the economy might do, and they're the most valuable to us. There are also others, the coincidental indicators, that change at the same time as the real GDP changes, and we'll come back to that a little bit later to talk about what examples there are. And then we have lastly the lagging indicators that change after the GDP really changes. So they also work in cyclical format, but they move after the actual GDP has changed. And let's look at some of these. Here's another clip to talk about the leading and lagging indicators.
Leading and lagging economic indicators. A leading economic indicator is sort of like your body when you're going to catch a cold. You know, before the cold really hits you, you start to feel bad, you start to feel run down, your nose gets congested, and it's a sign, here comes the cold. Well, the same thing happens in the economy with our leading economic indicators. As the economy is about to slow down, we see things like consumer confidence get weaker, we see retail sales start to fall, and sure enough, that can be an indicator that the economy is going to slow down. But it also works on the other side. When the economy starts to move out of an economic recession, we see some of these leading economic indicators start to pick back up before the overall economy picks up. Things again like consumer confidence, the stock market, those types of things. On the other hand, we also have what we call lagging indicators. Lagging indicators are these parts of the economy that sort of lag the business cycle. For example, when the economy picks up, the level of output's increasing, but the unemployment rate usually lags the rest of the economy by 2 or 3 quarters, sometimes as much as a year. So the economy picks up, maybe a year before we see the unemployment rate actually start to fall. So those are leading and lagging economic indicators.
Before I start talking about specific indicators, where do I find these things? Okay, there's one good source, tradingeconomics.com. The first source of statistics is this site here, tradingeconomics.com. Really useful site. It gives you the tabular data as well as some graphical data. But what I also like is this little meter up here, and when it goes into the green, obviously it's good. You can see here that it's in the middle here relating to the GDP growth rate, and that's really what we're looking at. If we want to go a bit further, we click on that and we will get this particular graph, which is quite useful. You can see that we've had a few blips, or one of them in particular, and it looks as though the trend's up. But this particular function, if you click on that, you'll see that the trend of GDP is actually going up. So we're recovering okay, although we're coming off a low base. And if you remember, going back to this meter, it's sort of recovering and getting better, and that's why it's in the yellow. You've got lots of other things too, the unemployment rate, which is important. If we go down a bit further, you can see some of the leading indicators, co-registrations for example, the housing index, and business confidence. They're all looking up for the moment. But if you look at this one, which is a lagging indicator, the capacity utilisation, that's quite low. So we've got a fair bit of capacity for business to pick up production yet. So there's lots of stuff here. Going on, another important site is this one, the Australian Bureau of Statistics. You can see that here, if you go to abs.gov.au, the most important ones that we look at all the time is the key national indicators, and I've got them up here. And I'll be asking you guys to look at this quite often, but you can see here that the latest gross domestic product, the trend is 0.6 in the last quarter. and over the last year has been 2.9%. So against other countries, we've been performing quite well. So 2.9% growth in one period is quite good. We've got a whole lot of other indicators down here, which I'll come back to a little bit later. For example, here we've got the unemployment rate. Currently that is at 5.4%, and that's gone up by 0.2% in the last quarter. The next really important place that we can look at is the Reserve Bank of Australia. The Reserve Bank of Australia is a really important site. Not only are they the setters of monetary policy, i.e. the interest rates, they've got lots and lots of really good data for us to look at. In particular, it's this chart pack that I want to show you. So when you click on that chart pack, you'll see a whole range of indicators expressed in graphical format and chart format, which I really like and which I'm going to show you. I'm going to click on this one here, and you'll get the GDP growth rate table. You can see here that currently we've been coming off a bit of a high and going evening off over here, as you can see. Now it's got some really other good important data as well. The consumer price inflation, you can see it's coming off a low. It's breaking back into the middle here between 2 and 3%, which is the target that the Reserve Bank tries to achieve between 2 and 3%, and we roughly is going into that. But whether it's going to go back down or keep going up is anybody's guess, and that's why we must look at these indicators to find out what's going to happen. Okay, let's keep moving. Looking at some leading indicators. What are the leading indicators? Commodity prices. They're the mined commodities that we export mainly to the Asian market. So if there's increased demand for those, that will be good for our economy. Job vacancies. ANZ Bank, they're the ones that publish this data, and they simply look at all the job vacancies both in the printed press and the online press. US is our important trading partner. If their GDP goes up, then that will serve us as well in the future. Housing finance commitments, which basically means a number of housing loans and mortgages being taken out by both residential and business sectors. Production expectations. If businesses expect if they've got positive expectations about the economy and are indeed increasing production or plan to, obviously that will then flow out into an increased productive capacity and therefore extra GDP in our economy. Business confidence, very similar. Consumer confidence, that is also measured, and if consumers are more confident, their buying expectations go up, and therefore you would expect the amount of retail sales to go up, including new car sales. So new car sales again is a nice leading indicator. If people are buying lots of new cars, it then augurs well for increased economic activity. And retail sales are already mentioned. So if people are spending lots and lots, that's obviously going to translate into more action, economic activity in our economy. Now let's look at coincidental indicators. They're the ones that track with the level of GDP. Industrial production, so the level of industrial production, so if that's up, that will be reflected in the level of GDP at the time. The unemployment rate, that's a direct outcome of increased or decreased production. So if production goes up, more labour is required, and therefore the unemployment rate then tracks with that. Personal income levels. So as people become employed, obviously they're going to have more wages and so forth, and that's an important indicator. Lastly, lagging indicators. They're the ones that are very important to areas of the economy. They don't actually tell us anything in advance, but they do confirm what has happened in the past. Good examples are the CPI, which is a very important indicator, which we'll be looking at in more detail later. Business profits. Businesses take a while to report their extra level sales and profits and whatever has happened for the quarter, but that usually lags behind actual amount of GDP, economic activity, in our economy. Labour productivity, looking at how much labour contributes to the level of output in our goods and services, and importantly there, we're talking about the labour costs as a proportion of output, and that's a really important indicator of our economy. So at the moment, labour productivity in Australia is trending down, which means our labour is corresponding to what we do is more expensive, which is a structural thing which must be fixed over the long term. Changes in inventories in firms. So if there's a decrease in demand, then stocks or inventories rise, which then the businesses will then react to in terms of either scaling up production, or in case of inventories go up, they'll scale down production. Loans to the private sector is another good indicator. Okay, putting it all together now, what I've covered so far is looking at how to predict the level of economic activity and to determine what stage of the economic cycle we're in and which way it's trending. That's really important. And this information is taken by our good treasurer to try and manage our economy. While we're looking at managing the economy, there's a whole number of aims that the government has in terms of managing it. The first one, increase economic growth. That's fairly obvious. The more growth we have, the more the high standard of living for our people that we have, and we can satisfy more wants and so forth. Price stability. We're talking about the level of prices, inflation measured by the CPI. We want that to be as stable as possible. The Reserve Bank, who manages this through monetary policy, wants to have a target of anywhere between 2 and 3% inflation. Full employment, that's fairly obvious. The more people employed, the better we are all off. We also, or the government, tries to have an external balance in terms of its currency and in terms of its trading balance. More on that later. There's others as well. Distribution of income and wealth, that tends to be an issue more with Labor governments than with Liberal governments, but that's an aim that most governments try to achieve in one way or another. Okay, now when we have these aims, if one of them isn't satisfied, we have what we call economic problems, and I'm going to go through those now. So when economic activity is slowing, for example, we're in a downturn or indeed a recession, we have GDP is decreasing, which is obvious, but the big problem here is unemployment. Unemployment is increasing. Inflation, correspondingly, is decreasing. So a big problem here is unemployment and the lack of activity. On the other end of the scale, when economic activity is increasing, we're in an upturn or indeed a boom, we have the opposite occurring. GDP is increasing, which is good. Unemployment, which is decreasing, which is good. But inflation is increasing. So that is an economic problem which the government will try and solve. Okay, now let's put all this together. Now the best way I can explain this is by the government, what they try and do is take out the booms and take out the bottoms, if you like, the busts and the depressions, if you like, by trying to be somewhere in the middle. Okay, so they're trying to cut out the tops and cut out the bottoms, right? So we don't have the extremes of what either of those conditions bring. Now let's look at some of the policies. So if we want to address low GDP and high unemployment, the cycle is low. Okay, they're the things that the government can do. Now, This little I is the economic term for interest rates. So the Reserve Bank can decrease interest rates, and that's part of the monetary policy. In terms of the fiscal policy, the government can increase government spending and decrease taxes, or a combination of the both. It doesn't really matter. Okay, but those three policy levers can address high unemployment. What effects will there be? Well, if we have got low economic activity, whereby we increase government spending, decrease tax, increase interest rates, then that will hopefully stimulate economic activity. It will entice more spending and lending, entice more businesses to invest, but at a lower interest rate, it discourages saving, i.e. people will spend more rather than save. So the impact, this is important to realise, the impact is that the business cycle will go up again. And that's the whole reason why the governments have done those things. Now let's look at the other side. If we have high GDP, which means we've got high inflation, which is a problem, the things the government can do is increase interest rates, decrease government spending, and increase taxes. These three tools are there to slow the economy. What are the effects? Well, it decreases economic activity. Too much economic activity is not good for the economy. It discourages spending and lending. It discourages business investment. And what it does, because the interest rates are higher, it encourages saving. So it takes money out of the circular flow, which then, what cause does it have? It makes the business cycle go down, just tapers off a bit. Remember how I explained it before, if we are on a peak, it just takes it back within those acceptable bands, like I showed you before. Another thing which I must talk to you about is putting the horse before the cart. Lots of students get the progression of how the application of macroeconomic policy actually works. Right? So the business cycle determines action. For example, if our business cycle is going down, as it's currently doing in 2013, the action must be, we've got a problem, which is low employment or high unemployment or higher unemployment, okay, which then prompts the governments to act. In this instance, following it through my example, we want a lower interest rate, we want more government spending, and we want less taxation. Now that will then lead, hopefully, an impact upon the business cycle, and that can have a lagging effect of usually around between 9 and 18 months, particularly if we talk about interest rate changes on the business cycle. So over that period of time, the business cycle will recover. Now we've come to the end. First of all, I'd like to check your understanding. This is in the second book, the Global Economy book, chapter 13.2, Objectives of Economic Growth. I want you to do review question number 1, which is describing the government's economic objectives of internal stability. So don't worry about the external ones relating to the current account and the currency. Once you've done that, we're going to do other exercises, but one of your main tasks will be this. I want you to go back to the RBA, the ABS and the Trading Economics sites to gather data to present a report, and I want you to predict the level of economic activity for the next 6 to 12 months. Should be about a page. You can use lots of dot points, and I would say you would have to look at least half a dozen to about 6 or 8 indicators to help you read the tea leaves, as I call them, to see what the level of economic activity is going to be and what direction the business cycle will take. So that's your task. I hope you've found this useful. Obviously you can pause at any one time and rewind. If you don't understand something, you've got me to ask questions. So hopefully that was useful. and go for it. Thanks for listening.